All right, let's dive into Diebold Nixdorf's Q2 2025 earnings. Now, this one's interesting because on the surface, the numbers tell one story, but the way the market reacted, well, that tells a completely different tale. And this is really the core of it, the big puzzle we're going to unpack today. Diebold Nixdorf actually missed on their earnings per share. Now, 99 times out of 100, that sends a stock tumbling, but not this time. Instead, the stock jumped a pretty significant 6.1% in pre-market. So what on earth did investors see that the headline number didn't show? Yeah, that kind of enthusiasm, it tells you there's a much deeper story here. It's a clear signal that the market is looking right past that minor miss, and instead, it's focusing on how healthy the business really is and where it's headed. So let's break down the numbers and see what they were seeing. And just look at how narrow this miss actually was. I mean, we are talking about a single penny, 1 cent, on both a GAAP and non-GAAP basis. Now, contrast that with the revenue number. Whoa! They didn't just beat, they blew past it by nearly $33 million. That is a powerful signal from the top line, and it completely overshadowed that tiny little miss on earnings. So that's the key takeaway, right? Investors totally ignored the headline miss. They were buying the story underneath, the real strength in the company's operations, which were showing some serious momentum. Okay, let's start with free cash flow, a positive $12.6 million. Now you have to understand, this is a really big deal for them. It's their third positive quarter in a row, and it's a record for the first half of the year. This signals a massive turnaround from a company that, used to just burn through cash. Next up, check out the product backlog. It jumped to almost $1 billion, $980 million to be exact. When you have a backlog that strong, it gives you incredible visibility into future sales. It's like having the orders already lined up. And for investors, that is a massive, massive confidence booster. And the third big piece of the puzzle here is margin expansion. Their GAAP gross margin popped up by 150 basis points just from the last quarter. And listen, this isn't just a one-time fluke. It's proof that all their hard work on being more efficient and smarter about pricing is actually working. It's flowing right down to the bottom line. So the big question is, how did they pull all this off? Well, it wasn't just one magic trick. It was a whole series of smart, strategic moves that are really starting to pay off now. The CEO, Octavio Marquez, he really summed it up perfectly. He called it a solid quarter with strong order entry, disciplined working capital, and continuous improvement. Basically, this wasn't about some flashy, headline-grabbing announcement. It was about solid, disciplined, roll-up-your-sleeves execution, just getting the job done right. And here's a perfect example of what that looks like in practice: their whole local-for-local supply chain strategy. They started making these key parts for their cash recyclers right in Ohio, and just by doing that, they accomplished two huge things at once. First, they totally dodged a bullet on new tariffs from the EU, and second, they can now serve their super important North American customers way faster and more efficiently. I mean, how smart is that? It's a move that has a direct, positive impact. And believe me, the good news did not stop there. Their AI tech for retail, it's literally winning awards over in France. They're finally getting real traction in branch automation with their first big order for teller cash recyclers. They're expanding in huge growth markets like India with new ATMs. Oh, and on top of all that, they bought back $30 million of their own stock. I mean, this is a picture of a company that is just firing on all cylinders. Okay, so when you have this kind of strong performance, it gives management a ton of confidence. And they used that confidence to signal a really bullish outlook for the rest of the year. And that right there was a huge reason why the stock reacted so well. So they reaffirmed their full-year guidance across the board for revenue, EBITDA, and free cash flow. But here's the kicker. The really crucial detail was in the commentary. Management came right out and said they expect to hit the higher end of all of these ranges. Now, that is exactly the kind of confident language Wall Street loves to hear. So why are they so confident? Well, this chart really explains it all. See, their business has always been what we call back half weighted, meaning they make more of their money in the second half of the year. With over half, 54% of their revenues still to come, and that massive backlog we talked about already locked in, they have a super clear path to not just hitting their targets, but maybe even beating them. All right, so let's put it all together. You've got the big revenue beat, you've got the awesome operational momentum, and you've got super confident guidance. So what's our call on the stock?
Before we get to our final rating, let's quickly weigh the pros and the cons, the bull case versus the bear case.
Okay, so the bull case is pretty clear, right? And it's compelling. The cash flow momentum is real. Their AI stuff is actually winning awards and getting traction. Their lean operations are pushing margins higher. And that huge backlog provides a really solid foundation for the future. Now, on the other hand, the bear case is really about stuff they can't control, big macro risks, things like currencies bouncing around, the retail sector may be slowing down, or getting hit with some new surprise tariffs. But when you weigh all the evidence, it's pretty clear to us that the company's internal momentum, it just far outweighs those external risks. I mean, these guys are executing exceptionally well. They've turned the ship around from a company that burned cash to one that generates it with discipline. And for all those reasons, our rating on Diebold Nixdorf is outperform. And of course, just a reminder that this analysis is for informational purposes only. This is not financial advice.